Hi everyone, today we'll be going over accounts October-November 2021, paper 2-2, question number 1. This is structure paper 2, which consists questions of 90 marks and it also has a time limit of 90 minutes. Since question number 1 is of 30 marks, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. We're given the balances that have been extracted from the books of P Limited on 31st August 2021. Alright, let's have a look at the question. And we're also given the information that the freehold property was revalued on 1st September 2020. So this is the opening date since the closing date was 31st August 2021 and the property was revalued at 58,000. The revaluation has not yet been recorded in the books of accounts. For the first part, we need to prepare the journal entry in order to record the revaluation of the freehold property on 1st September 2020. We do not require any narrative. So whenever we're talking about revaluation, obviously revaluation reserve is involved. So let's look for revaluation reserve in our given information. So we have revaluation reserve right here and it is of 6,000. Now we're talking about freehold property. So we also need to know the value of the freehold property before the revaluation. So we're looking at the value on 31st August 2020, which is again given right here. So the freehold property at valuation was actually 66,000 on 31st August 2020, but we revalued it to 58,000. So obviously there is a revaluation downwards, which means that there was a revaluation loss, or we can also consider it as an impairment loss. So let's figure out the value of the loss. So previously it was at 66,000 and currently we revalued it to be 58,000. So the difference is just going to act as the revaluation loss, and this difference is of 8,000. So out of this 8,000, 6,000 is accounted for by the revaluation reserve because we have the value of 6,000 right there. But if we record 6,000 towards the revaluation reserve, then again 2,000 still remains for this revaluation downwards, right? So this 2,000 must be recorded under the income statement. And we're talking about revaluation downwards. So obviously the capital is being decreased. And whenever there is a decrease in capital, that is recorded on the debit side in a journal entry. So we will record the retained earnings and the income statement with the amount 6,000 and 2,000 respectively on the debit side. And we will record freehold property with the revaluation amount of 8,000 on the credit side, because since freehold property is an asset, the decrement in assets are always recorded on the credit side. Let's write that down. So we have the debit side and the credit side. Firstly, we have revaluation reserve. And this reserve has a value of 6,000. Then the remaining 2,000 should be accounted to the income statement. Then the total of 8,000 must be accounted to the freehold property. That should be recorded on the credit side. Alright, this completes our journal as well as the first part. Let's move to the second one. Now again, we are given information, lots of information. And we need to prepare the income statement for the year ended 31st August 2021. And we must use the space on the next page for our workings. Alright, I've been scribbling around the question paper for previous solved papers. So I'll be trying my best to use the space for this question. Alright, we'll start with the revenue. So revenue, we're given an additional information right here. It includes goods sent to a credit customer on 23rd August 2021. Again, we're preparing the income statement at the end date of 31st August 2021 on a sale or return basis. And the directors were uncertain whether any of these goods would be returned. So whenever we send goods to a credit customer on a sale or return basis, that amount should not be included in the revenue. It should actually be included as a closing inventory in our income statement. So we're given the selling price of the goods to be 6,400. So this is the selling price of the goods, which should be deducted from the revenue. And we should actually utilize the cost price out of this selling price and add it to our inventory, which is given in the second information. And we have been told that the goods had been sold at a gross margin of 25%. So if the goods is being sold at a rate of 6,400, which consists 25% gross margin, that just means that 25% of it is going to be the profit, and then 75% of it is going to be the cost. And we need to include the cost value in our inventory. So let's just figure out the cost first. So our inventory should be 75% of 6,400. So that's just 0.75 into 6,400, which gives the inventory value to be 4,800. This is the value that should be added to the inventory. Inventory in P Limited's warehouse at 31st August 2021. So this is the closing inventory, was valued at cost 18,600, and we must add the 4,800, which relates to the goods that were sent to a credit customer on a sale or return basis, which gives our total closing inventory to be 23,400. Okay, now let's have a look for the revenue. So revenue is given right here. Revenue has a value of 216,600. So we must deduct the value of 6,400 from this amount and include that value in our income statement. Let's utilize the working section. For revenue, the revenue amount given in the information above was 216,600, and we must deduct the value of the revenue from goods sent to a customer on sale or return basis, which was of 6,400. So this gives us the total revenue to be included in the income statement to be 210,200. Let's write it down. Okay, now we move toward the cost of sales. First, let's have a look at the table and figure out the items that should be included in the cost of sales. The first one is going to be carriage inwards with a value of 390. Then we have opening inventory with the value of 22,800. Then we have purchases with a value of 88,900. And again, we have return outwards. So returns outwards just means purchases returns. So this value should be deducted, which is of 260. Then we don't have any other items in this table, but we are given the closing inventory value of 18,600, but we already added the cost of the goods that were sent to a credit customer on sale or return basis, which gives us the total closing inventory to be 23,400. So these are the 5 items that should be recorded under cost of sales. Let's write it down. So the first one was carriage inwards. We obviously add the amount in cost of sales. Then we had opening inventory. We again add the opening inventory value as well. Then we had purchases, which again we add. Then we had return outwards. We subtract that value. Then finally we had our closing inventory, which should be subtracted as well. So the value for carriage inwards was 390. The value for opening inventory was 22,880. The value for purchases was 88,900. The value for return outwards was 260. And the value for closing inventory was 23,400. Alright, so that's 390 plus 22,880 plus 88,900 minus 260 minus 23,400, which gives the total cost of sales to be 88,510. This is the value we need to include in our income statement, so let's substitute it. So we will write it in a bracket because we need to subtract the cost of sales from revenue in order to figure out the gross profit. So the gross profit is just going to be 210,200 minus 88,510, which gives 121,690. Alright, now we can move on to the administrative expenses. Let's have a look in order to figure out the items that must be included in administrative expenses. So the first one is the administrative expenses given in our table with the value of 35,110. Then let's have a look at the additional information. So we're given information relating to debenture interest, so that falls under financial cost. We have delivery vehicle licenses, so since this is delivery, we can just include it in our distribution cost. Then for the fifth one, we're given that the wages and salaries of 620 were outstanding, and then wages and salaries are to be charged to administrative expenses. So firstly, we need to figure out the total wages and salaries. Let's have a look for the amount from the table above. So wages and salaries are given right here. And this had the value of 26,100. Let's write that down. And we're also told that 620 were outstanding. This means that 620 were the expenses relating to wages and salaries of this particular year. And since we're talking about income statement, we need to include all of our incomes and expenses relating to this particular year. So we will also be adding this amount of 620. Now this gives the total wages and salaries to be 26,720. Now out of this wages and salaries, 25% must be recorded under the administrative expenses. Then we again have an information relating to delivery vehicles, so that falls under the distribution cost. We have freehold property, which was used only as a distribution warehouse. Again, this comes under distribution cost. And the depreciation for these assets, obviously if the assets are utilized in the distribution warehouse, then the depreciation must be charged to our distribution cost as well, which means that administrative expenses only record those two items. The first one was the amount of 35,180 given in our table above, and the second one is the 25% of wages and salaries amounting to 26,720. So let's write that down under our working section. So firstly, we have the administrative expenses amounting to 35,180, and then 25% of the wages and salaries. So we can just write it down as 0.25 into the amount for wages and salaries, which we figured out to be 26,720. Now this gives us the total administrative expenses of 41,860. This is the amount that should be recorded in our income statement. So let's do that. We have 41,860. Let's write it in a bracket because we need to subtract all of our expenses. Now we can move towards the distribution cost. Let's have a look at what should be included under this heading. So the first one is going to be the distribution costs amounting to 44,320, which is given right here in our table. Now let's have a look at the additional information. Okay, firstly, we also need to record this value of 2,000 in our distribution costs because we are talking about a freehold property, right, which was only used in our distribution warehouse, meaning that the revaluation downwards should also be charged to the distribution cost. And since this is a revaluation downwards, this is a loss, right? So this must be included in our expenses under the heading of distribution costs. So that's two items. Then we have the delivery vehicle licenses of 540 had been paid for the year, meaning that this amount was of 12 months. But this year was ending on 31st December 2020, but we're talking about an income statement for the year ending 31st August 2021. So if we're talking about August, then we have September, October, November, and December that is not accounted to in this income statement, meaning that any expenses relating to these 4 months should not be recorded under our income statement. But out of this 540, this also includes the cost for this 4 months. So we need to subtract that. Let's figure out the cost for the 4 months. If for 12 months, the cost was 540, we're just going to use a simple unitary method. For 1 month, the cost is going to be 540 by 12. Then for 4 months, the cost is just going to be 540 by 12 into 4, which gives the cost for these 4 months to be 180. So this 180 can be treated as a prepaid expenses relating to the delivery vehicle license. And since these are the expenses relating to a future accounting period, we do not include this in our income statement. So we must subtract this amount of 180 under the heading of distribution costs. Okay, that's the third item. Then we have wages and salaries, out of which 75% should be accounted to the distribution cost, meaning that the 75% of this amount should be included in our distribution cost. So that gives us the total of 4 items. Then we are also given another information relating to delivery vehicle. So on 31st August 2021, a delivery vehicle was sold for 7,000. So this is the sales value. Then the vehicle had been purchased on 1st September 2018 for 13,000. This is the cost. No entries for the sale had been made in the books of account, and the sale proceeds had not yet been received. So whenever we're talking about sale of an asset, we can also term it as a disposal of asset, right? And disposal basically comes with 2 items. So either there can be a profit on disposal or there can be a loss on disposal. And since we're talking about distribution cost, we're assuming that there is a loss. Now we need to figure out that loss and include it in our distribution cost. In order to do so, firstly, we need to figure out the net book value at the date of sales. And we also have another information that a full year's depreciation is charged in the year of purchase, but none in the year of disposal. All right, so let's make a timeline. I think that would be easier. So we're talking about the year ended 2021 August. So 1 year before that would be 2020 August. Then we have 2019 August. And we have 2018 August. And we're told that the vehicle had been purchased on 1st September 2018, which is right here, right? So we purchased it right here, and we sold it on 31st August 2021, which is right here. And what we know is that a full year's depreciation is charged in the year of purchase. So we charge depreciation for this year. We also charge depreciation for this year, but what we know is that we do not charge any depreciation in the year of disposal. So we do not actually charge any kind of depreciation for the last year. So we just need to figure out the depreciation for these 2 years. Okay, now we need to know the rate that we are charging to the delivery vehicle and also the method of depreciation. So for delivery vehicles, the information is given right here. It was 20% per annum reducing balance. So for the first year, since there is no accumulated depreciation, we can just figure out the depreciation amount by multiplying the rate with our cost of the vehicle, which is 13,000 into the rate is 20%, which can be written down as 0.20. Now this gives us the depreciation for the first year to be 2,600. Now for the depreciation for a second year, this value acts as the accumulated depreciation, meaning that we need to reduce this value from the cost and then multiply it with the rate. So that's just 13,000 minus 2,600 into the rate, which is 20%. We can write it down as 0.20. This gives us the depreciation for the second year to be 2,080. Now the total accumulated depreciation for this particular year is just going to be 2,600 plus 2,080. Let's figure out the accumulated depreciation. So that's 2,600 plus 2,080, which gives the total accumulated depreciation to be 4,680. All right, we already have the cost and we already figured out the accumulated depreciation, meaning that it is super easy to figure out the net book value, because net book value is just the difference between the cost and the accumulated depreciation. And the cost is 13,000 and we have the accumulated depreciation of 4,680, which gives our net book value to be 8,320. So this is the actual value of the delivery vehicle, but we only got 7,000 for that particular delivery vehicle, meaning that we sold it at a loss, right? So the loss on disposal is just going to be the difference between the net book value and the sales. So net book value is 8,320 and the sales value is 7,000. So our loss on disposal is just going to be 1,320. This should also be treated as an expense and included in our distribution cost. So that's the fifth item. Then we have the freehold property, which is used only as a distribution warehouse. And since this is only used as a distribution warehouse, we have to charge depreciation to our distribution cost. And we're given the information that its remaining useful life at 1st September 2020 was estimated to be 40 years. So if we had the estimated lifetime and we have the value, then we can easily figure out the depreciation per year by just dividing the value of our property by the estimated years. So in this case, the value of the property was revalued to 58,000. So we're just going to divide 58,000 by 40 in order to figure out the depreciation for this particular year. You can write it down in our working section. So depreciation for freehold property. So we just divide the value of 58,000 with our estimated lifetime of 40 years, which gives the depreciation per year to be 1,450. Nextly, we also have to figure out the depreciation for delivery vehicles. Okay, let's have a look at the cost and the accumulated depreciation given in our table. All right, the cost for the delivery vehicles was 89,420, and the provision for depreciation or the accumulated depreciation was 42,200. So let's utilize these values and figure out the depreciation for the year. And we know that for delivery vehicles, the depreciation is charged in a reducing balance method. It means that we need to reduce our accumulated depreciation from the cost and then multiply it with the rate. So we have the delivery vehicle's cost to be 89,420. But the thing to remember here is that we also sold a delivery vehicle costing 13,000. So that 13,000 should not be included in the cost anymore. So we can just subtract the 13,000. Right, now we need to subtract our accumulated depreciation. So accumulated depreciation from the given table was 42,200. Again, we sold a delivery vehicle with the cost of 13,000, and that particular delivery vehicle also had the accumulated depreciation of 4,680, which we just figured out above. So that accumulated depreciation should not be included in the value for this accumulated depreciation. So let's just reduce that as well. All right, now we can multiply it with the rate. So the rate is just 20%, which can be written down as 0.20. So this gives us the depreciation on delivery vehicles for this particular year to be 7,780. All right, so these are the 7 items that we need to include in our distribution cost. So I'm just going to write down the headings first. So the first one was the value of the distribution cost given in the above table. Right, and then we have the revaluation of freehold property. Then we had the prepaid delivery vehicle license, and since we're talking about a prepaid, we actually need to subtract it because we don't want to include it in our distribution cost for this particular year. So that's prepaid vehicle license cost. Then we also need to include 75% of wages and salaries, so that's 0.75 wages and salaries. Then we had a loss on disposal. Then we had depreciation on freehold property. And depreciation on delivery vehicles. All right, now we just need to substitute the values. So distribution cost in the table had the value of 44,320. Then the revaluation of freehold property that needed to be charged to the income statement was 2,000. Then the prepaid vehicle license cost that we figured out for the 4 months of September, October, November, and December was 180. So we need to subtract it. Then 75% of wages and salaries. So that's going to be 0.75 into the amount of the wages and salaries that we calculated to be 26,720. Then the loss on disposal, again, we figured that out above, and it had the value of 1,320. Then the depreciation on freehold property, again, we figured it out right above to be 1,450. And the depreciation on delivery vehicles was 7,780. So the total distribution cost is 44,320 plus 2,000 minus 180 plus 0.75 into 26,720 plus 1,320 plus 1,450 plus 7,780, which gives the total of 76,730. So this is the value of the distribution cost that should be included in our income statement. Let's do that. Again, we write it in a bracket because we need to subtract this. Now, in order to figure out the profit from operations, we just need to subtract the administrative expenses and distribution costs from the gross profit. So that's going to be 121,690 minus 41,860 minus 76,730, which gives the profits from operations to be 3,100. All right, then we need to figure out the finance costs. Let's have a look above. So debenture interest was given right here and had been paid to 30 June 2021. But we're talking about an income statement ending on 31st August 2021. So the debenture interest for the month of July and August had not been paid. So 2 months interest was outstanding. So we need to include that value. First, let's have a look at the debenture interest paid. So interest paid is given right here. And this had the amount of 1,590. So these were the interest paid for 10 months. And for the remaining 2 months, we are given the information on debentures here. So the debenture was of 36,000 and the interest to be charged on debenture was 5%. So 36,000 into 0.05 would give the interest for an entire year. But we only need the interest for the remaining 2 months. So we can just multiply it with 2 by 12. This is a unitary method. So this gives us the outstanding interest amount to be 300. So we need to add this 300 amount with the already paid debenture interest of 1,590 in order to figure out the total finance cost. Let's write it down in our working section. So that's going to be interest paid for the 10 months was 1,590 and then the remaining or outstanding interest for the 2 months was 300. So this gives the total for the finance cost to be 1,890. This is the amount that should be included in our income statement. Let's do that. So that's 1,890. Now, in order to figure out the profit for the year, we just need to subtract the finance cost from the profit from operations. So that's 3,100 minus 1,890, which gives the profit for the year to be 1,210. Okay, this concludes the income statement as well as our second part. Now we can move on to the third part. We need to prepare a statement to show the balance of retained earnings at 31st August 2021 after the preparation of income statement. So this is just a section from the statement of changes in equity and we're only including the section for the retained earnings. So let's just write down the headings first. So the first one, obviously we start with the opening balance or balance on 1st September 2020. Then for retained earnings, we deduct the dividends paid. So we can just write it down as less dividends paid. Then we always add our profit for the year to the retained earnings. And we already figured out that there was a profit of 1,210. So we just add that to the opening balance. So that's going to be profit for the year. Now this gives the closing balance or the balance on 31st August 2021. Alright, so we know that the profit for the year was 1,210. Then the dividends paid was, let's have a look in the table above. So dividends paid is right here and it amounted to 3,000, meaning that we need to deduct the 3,000 from our opening balance. Let's write that down. So we have 3,000. So now we need to figure out the value for either of the opening balance or the closing balance. In order to do so, let's have a look at the table above. Alright, we have retained earnings right here with the value of 24,200 and this will be our opening balance. So we just need to substitute this value and then figure out the closing balance of the retained earnings. Let's do that. So opening balance is 24,200. Now the closing balance will just be 24,200 minus 3,000 plus 1,210, which gives the closing balance to be 22,410. Alright, this concludes the third part. Now we can move to the fourth one. The directors wish to reduce the level of trade receivables. Now we need to state two ways in which the level of trade receivables of a business could be reduced. So if we're talking about trade receivables, it is directly associated with credit sales, because the lesser the credit sales, the lesser will be the value of the trade receivables. So the very first way to reduce the level of trade receivables is to reduce the value of credit sales. So we can just write it down as discouraging credit sales. And the second one would be to have an effective credit control. So if we're talking about credit control, it means that following up with our credit customers regularly and asking them to make the payments promptly by whether giving out some discounts or some sort of incentives, right? So we can just write it down as improving credit control. This concludes our fourth part. Let's move to the fifth one. We're given additional information again. The directors have plans to expand the business and they are considering two options. The first one is to make a rights issue of 80,000 ordinary shares of 0.50 each at a premium of 25%. And the second one is to issue 8% debentures, and we need to repay the debentures on the year 2027 to 2028 in order to raise 50,000. So we now need to advise the directors which option they should choose by justifying our decision. So the first one is we're considering whether to make a rights issue or debentures, right? So let's just write down what we know regarding rights issue and debentures. The first one is obviously that the rights issue is a permanent source of capital, whereas debentures need to be repaid at some future date, right? So let's write it down. Rights issue is a permanent source of capital, whereas debentures need to be repaid at a future date. Alright, next is that company already has a debentures, because we recently calculated the interest on debentures, right? And the company already had a debenture of 36,000 to be repaid next year. So if we are to issue again a debenture of 50,000, the company would heavily rely on the capital being brought in from debentures. That's not a good thing. That's a disadvantage to the company. So let's write it down. Company already has a debenture of 36,000 to be repaid next year, because the date for the previous debenture was 2022 to 2023. And then the additional debenture would make the company to rely on capital brought in from debenture, which is a disadvantage. Okay, then if you look at the interest on this debenture, that's 8%, but previously we figured out the interest at 5% rate. So the interest is very high compared to the previous one. Definitely affects the profit in a negative way. Let's write that down. Interest on debenture need to be paid, which reduces the profit. And we can also write that the 8% debenture rate is more expensive than the current debenture. So 8% interest rate is more expensive than the current debenture. All right. Then let's talk about right shares. So right shares definitely have voting rights, which might dilute the control of the company. So we can write it down. Right shares have voting rights, which might dilute control of the company. Then lastly, we're issuing the right shares at a premium, right? We're given a premium of 25%. So we do not know whether the rights issue would be fully subscribed. Because if it's not fully subscribed, then we will be failing to acquire the required capital. So that will be a disadvantage. Will rights issue be fully subscribed? Okay, so we can just end our points here and make a proper decision. So based on what we wrote above, I would make the decision to advise the directors to choose option 1 because we already have enough debentures, and debentures interest is also higher as compared to the previous or the current debenture. So obviously it will reduce the profit, and you only had the profit of 1,210, which might be pretty low considering another debenture. So yeah, the safest option would be to choose option 1 and go with the rights issue. The directors should choose option 1. Alright, this concludes the 5th part as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And also make sure that you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.